Hi, I'm John Reade. I'm Chief Market Strategist at the World Gold Council. I'm joined today by George Cheveley, who's Global Gold Strategist at 91. And we're going to discuss the gold market in 2021. How are you doing, George?
Very well, John. Good to be here.
Thank you very much. It's good to see you again. I look forward to being able to meet up with you in person soon.
Yeah.
So look, gold has dipped recently after what was a banner year in 2020 around the coronavirus pandemic. What's driving the downturn this year so far?
You know, I think it's a strange one. I think, in fact, it's inflation, which might sound completely counterintuitive, but it's the fact that inflation expectations have risen so fast this year that I think the market is now sort of almost challenging the Fed and saying they're going to have to raise rates earlier than they're saying. And despite them reiterating their policy, there's definitely a worry you feel in the market about rates rising earlier than expected.
No, I'd certainly agree with that. And I think the reaction of the US fixed income market following the recent Fed decision is quite interesting, in as much as yields went down for about, 12 hours and then started heading higher again. It's as if the bond market doesn't believe the Fed and it wants to challenge it to perhaps get stronger statements. But I must admit, I'm not quite sure what Powell can do, because he's been very clear in terms of what he's planning to do.
Yeah, and I think the other thing is, you can see 2 months forward now in inflation because of the base effects. We're going to see inflation rise over the next 2 months, at least through to May, we calculate. And so it's not clear. I think we're going to continue with this sort of vein of thought from the markets, maybe for another couple of months, with inflation really dominating people's views. And I think we need to get through that, and people realize that the Fed aren't going to move. And inflation is not going out of control, but is still going to remain high. And that, to me, lays up the foundations for a very strong market in the second half.
I certainly think it could be choppy. We're going to see some big prints. There's no doubt about that in inflation. And I would be amazed if we don't see quite a lot of volatility coming through in the bond market. But maybe perhaps once those base effects have come through and the pickup in inflation can be seen to be temporary, as you say, that could set the tires for more stable, a stable performance, shall we say, from markets.
Yeah, and I think we've also got to remember, obviously, we had an incredibly strong run from exactly a year ago through to the end of August in gold prices. And as typically, both pricing and positioning overshot. And so we have had that moderation of both. But I mean, if you look at any models versus real rates, etc., gold looks fair value at best, if not slightly undervalued.
Yeah. One of the questions I get quite often is about Bitcoin and other cryptocurrencies, and is gold's weakness due to strength in Bitcoin? Well, do you get that question as well?
Yes, I do. No, quite regularly. And my answer is not just to dismiss it as ignore it, this is ridiculous, because the fact is there's a lot of money gone into Bitcoin, and I think at the margin some of that money would have been in gold. So I do think at the margins it's had an effect, but I don't think it's more than that. And I think the idea of sort of Bitcoin replacing gold somehow is way off, if not impossible. And I just remind people, really, as you do, the liquidity of the gold market on a daily basis is really comforting for a lot of people, and way better than most other markets.
Well, and the volatility of Bitcoin as well. I mean, it's multiples of that of gold. And we've been doing quite a lot of work on looking at gold and whether it is being threatened from Bitcoin. And certainly the conclusions we come to is that it is not. And part of that's due to that volatility. Liquidity, as you point out, is also another factor. But the other thing is correlations too. Bitcoin seems to be tracking high-tech, rapid growth US equities. So it doesn't really diversify a portfolio in the same way that gold does. It's not to say potentially that Bitcoin might not be a bad thing to have in a portfolio, but it doesn't give you the same diversification characteristics and the potential to help protect during downturns. So I agree with you. There's speculative money in gold. There's only really speculative money in Bitcoin. Could a bit of it have been funneled out of gold and into Bitcoin? Yeah, I'm not going to rule that out. But I think in terms of investment, the characteristics of the two assets are very different.
Yeah, and the final thing is still, and okay, they will come down, but transaction costs in Bitcoin are very steep still.
They are, and they will remain high while interest remains high in Bitcoin. So yes, they may come down, but probably only if Bitcoin prices come down as well. So it's a bizarre asset that gets much more expensive to trade the more popular it becomes, which I think is one of its not a particularly good unique selling point.
Yeah.
Commodities have done well though. Certainly in the last few months, we've seen very strong non-precious metal commodity prices. Forecasted by some to enter another super cycle. Why is gold lagging? Do you have any strong views on that?
Yeah, I mean, gold has lagged obviously this year, but you've got to remember it got well ahead of other commodities in the middle of last year. It was first to recover out of the pandemic, and then to some extent has been overtaken. But I mean, over a year they're all up quite strongly, and that I think makes sense. I think you've got to remember on some of the base metals, etc., what we saw was a massive demand shock. And unusually, we saw a big supply shock at the same time because a number of operations were hit by the virus and had to either slow down or stop. And that meant that when the recovery came through in the second half of the year, and a strong recovery, stronger than most expected, we came from a very low inventory level. And what we're seeing is synchronized restocking on a global basis for the first time since 05-06, in my view. And that's led to very powerful, tight markets, shortages in various places, and higher prices. But whether that, that might just be a restocking cycle. To say it's now the start of a structural super cycle, I think is too early to say that. I understand the story. I just think it might be too early to say we've really hit another super cycle.
No, I think that's quite right. I mean, it's clear that economic growth is going to be good this year. And the inventory cycle, as you've spoken about, is going to play a clear role. Whether that sets us up for a super cycle or not, I think remains very much to be seen. So on to the final topic, and perhaps the one that listeners might be the most interested in, is where do you think the gold market's going to go for the balance of 2021?
Yeah, I think, as I said at the beginning, I think, it has been a tricky period and oddly because of higher inflation, where we would say that's normally good for gold, and I still believe it will be. And I think inflation will remain higher, but at a level that the Fed will tolerate. And therefore, with rates staying low, I mean, they really can't afford for rates to go up very high. And therefore, I think that real rates will remain negative. And I think that will support and even drive gold prices higher in the second half of the year, particularly if growth worries come back again, which if this is just a restocking cycle, they could. I would add though, and obviously this is what I look at, I think what really I'm confident about is the equity story. Because unless you think gold prices are going down significantly from here, and I find that hard to believe, and I mean significantly, they need to be below 1,500 for me to get worried. These equities are still enjoying some of the highest margins we've seen for, 40 years, and generating a huge amount of cash and being incredibly disciplined at the same time. I mean, they're still not greenlighting too many projects. They are handing a lot of cash back. We see the yield on these gold equities, the highest that I've ever seen, I think, this year. And I think that makes it a very exciting environment. And I talk to generalists who are going, wow, these equities actually have very good returns and they're returning it. That's really exciting. And therefore, unless you believe gold prices are really going to fall a lot, I think the equity returns can be strong this year.
Yeah, it's interesting, isn't it? Aside from the macro factors and perhaps the investment story in gold, which gains lots and lots of attention, I think commentators and observers of the market may be underestimating just how strong consumer demand for gold is returning. I mean, we've seen sequential improvements really since the trough back in the second quarter of last year, but I'm consistently surprised by how fast consumer demand's coming back in major markets, particularly in India and China. And I'd expect some interesting statistics to come out from the first quarter numbers when we put out gold demand trends. So I'm not as negative about the outlook for gold demand this year as I would be if I was just looking at investment demand.
Yeah, no, I think you make a good point. I mean, obviously, because of what happened a year ago, looking at the current to date numbers is it's very difficult because the percentages are huge. But it's interesting that it's not just gold. We see it happening in diamonds as well, where pricing has strengthened and demand. So it does sort of show that jewelry generally has been very strong.
Good. Well, thank you very much for joining me, George. It'll be fascinating to see how this year works out. It was a terrible year for the global economy last year, and obviously quite good for gold. Now we're in a recovery. It'll be really interesting to see how the gold market plays out for the balance of 2021. So thank you very much for joining us.
No, thank you, John. Always good to talk.